What's up, everybody? It's Bond, and welcome back to the channel. 2024 is shaping up to be interesting for the economy and markets. But hey, that doesn't mean your investment goals need to be put on hold. Today, we're diving into 5 bulletproof investment strategies to protect your money and help you come out ahead. We're talking about building long-term wealth here, people. The kind that sets you up for a comfortable retirement and helps you achieve your financial goals. So, if you're ready to take control of your financial future, buckle up, hit that like button, and let's get started. For example, consider diversifying your portfolio with a mix of stocks, bonds, and real estate. All right, let's kick things off with real estate investment trusts, or REITs. These investment vehicles have revolutionized the way people can invest in real estate. They offer a way to gain exposure to the real estate market without the need to directly own or manage properties. For example, some of the top REITs to consider are Realty Income O, known for its monthly dividends and diversified portfolio, and Prologis, PLD, which focuses on industrial properties and has a strong track record of growth. Another notable mention is Digital Realty, DLR, which specializes in data centers and benefits from the growing demand for digital infrastructure. These REITs have consistently provided solid returns and are well regarded in the industry. Not everyone wants to be a landlord dealing with tenants and late-night calls about leaky faucets. The stress and time commitment can be overwhelming. Imagine having to handle maintenance issues, tenant disputes, and the constant worry about property upkeep. That's where REITs come in. They're companies that own and operate income-producing real estate such as office buildings, shopping malls, apartments, and hotels. These companies manage the properties, collect rent, and handle all the operational aspects. For example, you can invest in a REIT that focuses on commercial properties, providing you with a steady stream of income without the hassle of property management. This means you can enjoy the benefits of real estate investment without the day-to-day responsibilities. REITs tend to pay out juicy dividends because they're legally required to distribute a significant portion of their taxable income to shareholders. This makes them an attractive option for income-focused investors. The dividends can be quite substantial, often higher than those from other types of investments. This means you get a steady stream of passive income, which can be a lifesaver when the markets are volatile. The consistent dividends can provide financial stability and peace of mind. Even during economic downturns, many REITs continue to generate income, offering a buffer against market fluctuations. They also offer diversification. Instead of buying a single rental property, you can invest in REITs specializing in different types of real estate, such as commercial, residential, or industrial properties. This diversification can help spread risk and enhance potential returns. Do your research. Look for REITs with a solid track record of dividend payments, a strong portfolio of properties, and a management team you trust. It's crucial to understand the underlying assets and the strategy of the REIT. Check their historical performance and read up on their future plans. Of course, like any investment, REITs come with their own set of risks. Their performance is tied to the real estate market, and interest rate hikes can impact their profitability. It's important to be aware of these factors. Additionally, economic downturns can affect property values and rental incomes. But overall, REITs can be a fantastic addition to a well-diversified portfolio, especially if you're looking for passive income and exposure to the real estate market without the landlord headaches. They can complement other investments and provide a balanced approach. By including REITs, you can achieve a more resilient and diversified investment strategy. So consider adding REITs to your investment strategy. They offer a unique way to invest in real estate, providing both income and diversification. With careful selection and research, REITs can be a valuable part of your financial plan. They allow you to benefit from the real estate market's potential without the direct involvement and stress of property management. Let's move on to strategy number 2, Dividend Aristocrats. These companies are like the royalty of the stock market, known for their stability, reliability, and dividends. A dividend aristocrat is a company that's part of the S&P 500 index and has increased its dividend payments for at least 25 consecutive years. For example, companies like Johnson & Johnson, J&J, and Coca-Cola, KO, have consistently increased their dividends, making them reliable choices for income-focused investors. Another strong contender is Procter & Gamble, PG, which has a diverse product portfolio and a long history of dividend growth. These companies have solid business models, strong cash flows, and a proven track record of navigating economic turbulence. Dividend Aristocrats can provide a sense of calm amidst market volatility. Those dividend payments can act as a cushion, softening the blow during market downturns. Reinvesting those dividends can supercharge your returns over the long run. Historically, they've tended to outperform the broader market during periods of volatility. If you're looking for a way to build a resilient portfolio that can withstand market storms, Dividend Aristocrats are worth considering. Just remember to do your research, diversify your holdings, and invest for the long haul. So, consider adding Dividend Aristocrats to your investment strategy. Chapter 3. Gold and Precious Metals, the OG safe haven. Let's talk about an investment strategy that's as old as time itself. Gold and precious metals. These assets have been revered across cultures and civilizations for their enduring value and universal appeal. From ancient Egyptian pharaohs to modern-day investors, gold has always been seen as a symbol of wealth and security. Gold has been a store of value for thousands of years, and it's still going strong. It's a tangible asset with intrinsic value. You can hold it in your hand, and it has a real-world presence that's comforting, especially when the markets are volatile. Unlike digital assets or paper money, gold's physicality provides a sense of security and permanence. For example, during economic downturns, gold tends to hold its value, providing a safe haven for investors. When inflation erodes the value of paper money, gold has historically held its ground. It's like a financial anchor, providing stability when everything else seems to be sinking. In times of crisis, people often flock to gold, driving up its value and reinforcing its status as a reliable investment. Some of the top precious metals to consider are gold, silver, and platinum. Gold is often seen as a safe haven during economic downturns and is a popular choice for preserving wealth. Silver, on the other hand, has industrial applications and can benefit from economic growth. Platinum is rarer than gold and silver and is used in various industries, including automotive and jewelry. Gold's value tends to increase when other asset classes decline. This negative correlation makes gold a valuable tool for diversification. By including gold in your portfolio, you can potentially reduce overall risk and enhance long-term returns. Diversification is key to a balanced investment strategy, and gold plays a crucial role in achieving that balance. Of course, gold isn't without its risks. Its price can be volatile in the short term, and it doesn't always move predictably. Market sentiment, geopolitical events, and changes in supply and demand can all influence gold prices. It's important to be aware of these factors and not to expect gold to be a quick profit maker, but over the long term, gold has proven to be a reliable store of value and a hedge against inflation. Even a small allocation to precious metals can add a layer of protection to your portfolio. This long-term reliability is why many financial advisors recommend having at least some exposure to gold. Investing in gold can be done through physical gold, ETFs, or mining stocks, each offering different advantages. Physical gold offers direct ownership and no counterparty risk, while ETFs and mining stocks provide liquidity and ease of trading. Each method has its own set of benefits and drawbacks, so it's important to choose the one that aligns with your investment goals and risk tolerance. So consider adding gold and precious metals to your investment strategy. Whether you're a seasoned investor or just starting out, these assets can provide a solid foundation for financial stability. In a world of uncertainties, gold remains a timeless choice for preserving and growing your wealth. Its historical significance and enduring value make it a cornerstone of any well-rounded investment portfolio. Chapter 4. Emerging Market ETFs. Tap into the global growth engine. Let's talk about a strategy that's all about tapping into the growth potential of the global economy. Emerging Market ETFs. These funds are designed to give investors exposure to the economic dynamism of developing countries. For example, some of the top emerging market ETFs to consider are Vanguard FTSE Emerging Markets ETF VWO, which offers broad exposure to emerging markets, and iShares MSCI Emerging Markets ETF EM, which focuses on large and mid-sized companies in emerging markets. Another notable mention is Schwab Emerging Markets Equity ETF, SKI, which provides a low-cost option for gaining exposure to these high-growth regions. These ETFs can help diversify your portfolio and capitalize on the rapid growth occurring in these markets. Emerging markets can be volatile, but they also offer incredible opportunities for growth. The volatility often stems from the rapid changes and developments happening in these regions, which can lead to significant gains if navigated wisely. The key is to understand the underlying factors driving this volatility, such as economic reforms, demographic shifts, and technological advancements, which can create a fertile ground for substantial investment returns. For example, investing in an ETF that focuses on China or India can provide significant growth opportunities as these countries continue to industrialize and expand their economies. The rapid industrialization in these nations is accompanied by increasing consumer demand, urbanization, and infrastructure development, all of which contribute to robust economic growth. Similarly, countries like Brazil and Mexico are also experiencing transformative changes that can offer lucrative investment prospects. Investing in an emerging market ETF allows you to diversify your portfolio geographically without having to pick and choose individual stocks. This geographical diversification can help mitigate risks associated with investing in a single country or region. By spreading your investments across multiple emerging markets, you can reduce the impact of localized economic downturns and political instability, thereby enhancing the overall stability of your portfolio. It's like having a team of expert investors hand-picking the best companies in emerging markets and bundling them up into a convenient, low-cost investment vehicle. This professional management can provide peace of mind and potentially better returns. These experts conduct thorough research and analysis to identify companies with strong growth potential, ensuring that your investment is well positioned to benefit from the economic progress in these regions. Emerging market ETFs offer the potential for high growth as these economies continue to expand. The growth potential is driven by factors such as increasing industrialization, urbanization, and technological advancements. As these countries develop, they often experience rapid GDP growth, rising incomes, and improved standards of living, all of which can translate into higher corporate earnings and, consequently, higher returns for investors. They also provide diversification benefits by spreading your risk across different countries and sectors. This means that even if one market underperforms, others may perform well, balancing out the overall risk. Additionally, emerging market ETFs often include a mix of industries such as technology, finance, and consumer goods, further enhancing the diversification and resilience of your investment portfolio. Of course, emerging market ETFs are not without their risks. It's important to be aware of the potential downsides before investing. These risks can include economic instability, regulatory changes, and geopolitical tensions, which can all impact market performance. Understanding these risks and having a long-term investment horizon can help you navigate the uncertainties and capitalize on the growth opportunities. These markets can be volatile and their performance can be influenced by factors like political instability, currency fluctuations, and commodity price swings. Political changes can lead to sudden market shifts, while currency fluctuations can impact returns. Additionally, commodity-dependent economies may experience volatility due to changes in global commodity prices, which can affect the profitability of companies within those markets. But over the long term, emerging markets have the potential to deliver significant returns. Historically, these markets have shown strong growth trends, making them an attractive option for long-term investors. By staying invested through market cycles, you can benefit from the compounding effect of growth and potentially achieve substantial wealth accumulation over time. So, consider adding emerging market ETFs to your investment strategy. They can be a valuable component of a diversified portfolio, offering exposure to high-growth regions. By including these ETFs, you can enhance your portfolio's growth potential while managing risk through diversification. It's a way to tap into the global growth engine and diversify your portfolio. By investing in emerging market ETFs, you can participate in the economic growth of developing countries while managing risk through diversification. This approach allows you to benefit from the dynamic and evolving global economy, positioning your portfolio for long-term success. Chapter 5: Cryptocurrency The Wild West of investing. Let's talk about the elephant in the room, cryptocurrency. Cryptocurrency has had its fair share of hype, speculation, and scams, but beneath all the noise, there's a transformative technology with the potential to revolutionize finance. For example, some of the top cryptocurrencies to consider are Bitcoin, BTC, which is the most well-known and widely adopted cryptocurrency, Ethereum, ETH, which offers smart contract functionality and is the backbone of many decentralized applications. Another notable mention is Binance Coin, BNB, which is used on the Binance exchange and has various use cases within the Binance ecosystem. These cryptocurrencies have shown significant growth potential, but also come with high risks. It's not for the faint of heart, and it's definitely not something you should be investing your life savings in. But if you're curious about this emerging technology and willing to accept the risks, you might consider allocating a small percentage of your portfolio to cryptocurrency. The key to investing in cryptocurrency is to do your research, understand the technology, and only invest what you can afford to lose. Don't get caught up in the hype or FOMO, fear of missing out. Approach it with caution and a long-term perspective. So consider adding cryptocurrency to your investment strategy if you're looking for high-risk, high-reward opportunities. Outro your path to financial freedom in 2024. There you have it, folks. 5 rock-solid investment strategies to help you navigate the exciting world of investing in 2024 and beyond. If you found this video helpful and informative and you're ready to take control of your financial future, give it a thumbs up and share it with your friends. Until next time, happy investing and stay informed. For example, by following these strategies, you can build a diversified portfolio that balances risk and reward, setting you up for long-term financial success. Remember, the key is consistency and informed decision-making.